chances are you've been in a CVS in the last year, I would bet, either to pick up a prescription or it's just so convenient. You walk in there and get something that you need, a bag of chips or something. You may also be a member of their healthcare program. They provide their healthcare insurance to you since they acquired Aetna a few years ago. In today's video, I'm going to cover CVS Health. They announced their earnings yesterday, and I have some new data to update my analysis on this company. My name is Victor. I have an MBA and a lot of business experience, and I use that to analyze companies that I invest in. And in this video, I'll be covering CVS. Do me a big favor and like the video, subscribe to the channel if you haven't already. That way you can receive videos like these every so often. Now let's get into CVS. I like to follow a process as I invest in any company. It has 4 key questions followed by a decision whether I buy, hold, or sell. First question, do I want to be a part owner in this company? Do I like this industry? Do I think the management team is doing a good job at the company? Is debt under control and less than 3 times EBITDA? And I want to discount the stock. That way I could see my investment go up in value in the near term. Based on the answers to those questions, I buy more shares, hold, or sell this particular stock. Historically, CVS has been a pharmaceutical company, and they provide retail pharmaceutical products and so forth. But they entered the health insurance business by the acquisition of Aetna, and they wanted to diversify their business. They also have in-store or at their locations, you can get healthcare. So they have diversified, and the intent is that they just don't want to be a retailer. They want a more sticky business. They want a more profitable business. And based on their results so far, that whole model is working. I like the story. I like that the team is really expanding the company, expanding the brand so that they can have a longer lasting, successful business. CVS announced their earnings yesterday, and it was well received by the street. The stock went up 3.3% on a day when the NASDAQ went down more than 2%, and the S&P went down more than 1%. So good job, CVS. And the principal reason why the results were so good is revenue grew for this business and the size of this company to grow 10%. That's just a phenomenal job by their management team. Great job. Their earnings per share, very profitable company. Again, very good job. And the cash flow generation, which is one of the principal metrics that I follow, just jumped up from 9 billion to 13 billion cash from operations in the first half of 2023. Excellent job, CVS. The strategy that CVS is on is working. For guidance for the rest of the year, really solid earnings per share guidance, really strong free cash flow generation, and they're delivering strong results on a very ambitious strategy that the team has over at CVS. The balance sheet is in good shape. It's less than 3 times debt to EBITDA ratio. They have good cash and they generate a lot of EBITDA. CVS gets an A+ on their statement of cash flows. Their cash flow from operations in the first 6 months of 2023 went from $9 billion to above $13 billion in cash from operations. Just phenomenal job there. And if you look at their plant, property, and equipment, it did not go up very much. So just an excellent job of improving cash flows. I believe CVS is currently discounted by 56%. And I'd like to share with you my analysis as to what led me to believe that it's discounted that much. I use 2 methods. I'm going to discount the free cash flows that I expect from the company in the future. And then second, I'm going to look at earnings per share and value the company based on earnings per share. First, the free cash flows. So the guidance they're providing is that they're going to generate more than $9.5 billion of free cash flow. And I'm going to grow that at 8% for the first 4 years. After that, I'm going to grow at 3% for all years after year 4. Based on those, all the cash flows that we expect in the first 4 years are here. Then the terminal value of all cash flows beyond year 4 are $224 billion. Discount of 8.5% is going to be their weighted average cost of capital. Based on all those cash flows, if you discount it to today's value, it is valued at $184 billion to round up. They have cash on the balance sheet of $16.8 billion. They have debt on the balance sheet of $4 billion. So it gives them an equity value of $138 billion, but their market cap currently is only $97 billion. So it offers up a 38% discount using the discounted free cash flow method. Earnings per share is a little even more advantageous, and that's because their earnings per share is $8.50 per share. I'm going to use a PE of 20, even though for their type of business, health insurance company, retailer, it could be higher. I'm going to go with 20, and growth rate of 3% on that. And based on the earnings per share value, it's 94. It's currently discounted. It's being sold at a discount of 94%. Now, I blend the two and I take more weight into the free cash flow method. I go 2 parts free cash flow method, 1 part earnings per share method, and I arrive at that 50% discount that I believe the CVS stock is currently trading at. It's very gratifying to do the analysis on a company and see where there's an opportunity for a lot of value to be gained in an investment. I believe that the per share price of CVS is really $119.40 per share. And I showed you my analysis based on free cash flow and earnings per share. And based on that value there, the company's traded for the last 5 years, and it's gotten close to that value, I guess around 2022, 2023, it was trading around that value. But more recently, especially this year, it's down 17.7%. Now, that is an opportunity. I've been buying into CVS because I believe CVS is worth more. We're beginning to see that rise. So hopefully that continues, but this is the opportunity. This is why it pays off to do analysis, to really study a company, know it, so that you can take advantage and buy when nobody else wants to buy. So you could buy it at a really low price and then see it rise, kind of like it rose from in the 2021 era up to 2022. And keep in mind, you're being paid a 3.3% dividend. So it's nice to have some return, even if the stock has been falling. I've been an owner in CVS, and yeah, this period is not fun when you see your stock go down, but it's an opportunity. I've been buying big into CVS, and hopefully, fingers crossed, that investment will pay off. So let's revisit the scorecard for CVS. So I definitely want to be part owner in this business. I think it's a really good business. The management team keeps making it better by diversifying it. And I can't say enough good things about this management team. Excellent strategic management team, excellent operations, excellent cash flow. Debt is under control, really good discount available on CVS. So I'm buying CVS. Thank you for watching my video. I really appreciate it. Please do me a favor, like my video, consider subscribing if you want to see more videos like this. Really appreciate your time. And I hope you have great success in investing in 2023.